Global investors take advantage of differences in interest rates across markets. They borrow where it is cheap and invest where the return is high. Let's assume that FIIs borrowed at 1% in the global market and invested in Indian debt markets at 8%. Assume that they invested $100 when exchange rate was 50 rupees to a dollar. This would mean that they invested $100 multiplied by rupees 50 or 5,000 rupees in the debt market. After 6 months, they review their position. They would have hoped to earn 4% over 6 months. 4% is half of 8% for 6 months. This means the value of their investment would be 5,000 rupees multiplied by 1.04 or 5,200 rupees. If the rupee did not depreciate, this would translate into 5,200 divided by 50 or $104 or a return of 4% against a borrowing cost of 0.5%. 1% for a year is 0.5% for 6 months. This leads to a net gain of 3.5% over 6 months or 7% per annum. The net return simply is return from investment less cost of borrowing. Instead, assume that the rupee depreciates to rupees 60. Therefore, the rupees 5,200 that they earned is now worth 5,200 divided by 60 or $86.67. They have made a rupee gain of 4%. But since the currency depreciated, they are left with a loss in dollar terms. Their return is minus 13.33%, and adding the cost of borrowing, they lost 14.33% in 6 months. The depreciation in the currency is higher than the difference in interest rates between the two markets. So, global investors will not look at interest rate alone, but they'll also take a view on the currency. If the currency is expected to depreciate even more than the difference in the interest rate, they will pull out money. That is why FIIs were net sellers in the Indian debt market in July 2013 when the rupee depreciated sharply. What would stop FII exit? Either the yield should be high enough to cover the depreciation in the currency, or the currency should not fall more than the interest rate differential. At the point where the currency depreciation is not expected to be more than the interest rate differential, inflows will return.